If you're watching this because you hold silver or you're thinking about it, this video is for you. But the conclusions you take from it depend on your investment plan. Are you looking at silver as a trade, a hedge, or long-term protection? Tell me, because the next analysis will be built around your position. Silver futures traded near $120 per ounce this week before pulling back sharply. Yet walk into a coin shop or check dealer websites and you'll find a different reality. Elevated premiums, limited inventory, and in some cases, paused buyback programs. If this were truly a price collapse, physical metal would be flooding the market. Dealers would be competing for your business with aggressive pricing. But that's not what's happening. This isn't a story about where silver's price is going next. This is an analysis of how two different silver markets, one made of contracts and leverage, the other made of bars and coins, are responding to the same underlying stress in fundamentally different ways. What you're witnessing is not a collapse, it's a divergence. And understanding why that divergence exists is essential to understanding what's actually happening in the silver market right now. Before we go further, let's establish who this analysis is for. If you're watching this, you likely fall into one of these categories. You're a long-term saver looking to preserve purchasing power across time. You're focused on retirement and wealth preservation rather than short-term trading. Or you're seeking clarity on how to protect yourself from currency debasement and systemic financial risk. This analysis is not for traders trying to time entries and exits. It's for people trying to understand the structure beneath the price movements, because that structure determines what works as a wealth preservation tool and what doesn't. Take a moment and identify where you stand. Do you hold physical silver, coins or bars in your possession or allocated storage? Do you hold paper silver exposure through ETFs, futures, or mining stocks? Or are you still learning, trying to decide what role, if any, silver should play in your financial life? Your answer matters, because the conclusions you draw from this analysis will depend on what you're trying to accomplish. A trading instrument and a wealth insurance tool are not the same thing, even when they track the same underlying asset. I'll be creating follow-up content based on where this audience is positioned and what risks you're navigating. The goal here isn't to tell you what to buy, it's to give you the analytical framework to make decisions aligned with your intent. Let's start with a foundational concept that most people miss. There is not one silver market. There are two. The paper silver market consists of futures contracts traded on exchanges like COMEX, silver ETFs like SLV and PSLV, and the vast derivative structure built around silver pricing. This market is highly leveraged. Participants can control large amounts of silver with relatively small capital outlays by posting margin. Most contracts are cash-settled, meaning actual metal rarely changes hands. Price discovery in this market is driven by volume, positioning, and the mechanics of margin requirements, not by whether physical silver is actually available. When you see silver quoted at $110 per ounce, that price is coming from this paper market. It represents the price at which contracts are trading, not necessarily the price at which you can obtain physical metal. The physical silver market consists of coins, bars, and industrial silver. It is influenced by mining supply, refining capacity, fabrication bottlenecks, and real demand from industry and retail buyers. This market is slower and far less liquid. When you buy a silver coin, someone had to mine that silver, refine it, mint it into a product, distribute it through supply chains, and deliver it to a dealer who then sells it to you. Every step in that process has constraints. Physical silver premiums, the amount you pay above the spot price, reflect these real-world costs: fabrication, shipping, dealer margins, and supply-demand imbalances at the retail level. In normal markets, premiums for generic silver products range from about 9% to 15% over spot. In stressed markets, those premiums can spike significantly higher. The paper market and physical market operate under different rules and different incentives. One is designed for liquidity and leverage. The other is constrained by logistics and physical availability. When stress enters the system, these two markets don't break in the same way. Paper markets break when leverage unwinds. Physical markets tighten when supply can't meet demand. Understanding that distinction is the foundation for everything that follows. Now let's talk about what breaking actually means in the context of the paper silver market. In late December 2025 and early January 2026, COMEX futures prices for silver surged to record highs, briefly exceeding $84 per ounce. But the rally didn't hold. Prices pulled back sharply, at one point falling 17% in a matter of days. This wasn't a collapse in silver fundamentals. It was a liquidity and leverage event. When silver prices rise rapidly, exchanges respond by raising margin requirements. Margin is the collateral that traders must post to hold leveraged positions. On December 26, 2025, CME Group raised initial margins for silver futures contracts from approximately $22,000 to $25,000, a 13.6% increase. 4 days later, on December 30th, margins were raised again to $32,500. In less than a week, the capital required to hold a silver futures position increased by nearly 50%. Additionally, on January 13, 2026, CME shifted from dollar-based margin requirements to percentage-based margin requirements, setting silver futures margins at 9% of contract value. This means that as prices rise, margin requirements automatically rise in tandem, creating continuous pressure on leveraged positions. When margin requirements increase suddenly, traders face a choice: post additional capital or close their positions. Many can't or won't post more capital, especially in a volatile market. The result is forced liquidation. Traders selling positions not because they've changed their view on silver, but because they can no longer afford to hold the leverage. This selling is mechanical, not fundamental. It's not driven by a shift in supply and demand for physical silver. It's driven by the rules of exchange-traded derivatives. Algorithmic and momentum-based trading systems amplify this dynamic. When prices start falling and volume spikes, algorithms detect the move and initiate additional selling. This creates a self-reinforcing feedback loop. Falling prices trigger more margin calls, which trigger more selling, which triggers more algorithms, which drives prices lower still. These sharp pullbacks are a feature of leveraged markets, not a bug. They occur when leverage becomes unsustainable and the system forces a reset. But they say very little about the underlying physical market. Paper markets break under leverage stress, not scarcity. The price you see on a futures screen is a function of positioning, margin calls, and liquidity conditions in the derivatives market. It is not a direct reflection of how much silver is available or how hard it is to get. Now let's look at the physical side. While futures prices were swinging violently, the physical silver market was telling a completely different story. According to dealer data from January 2026, premiums on physical silver products remain elevated. Generic silver bars, which typically carry premiums of 9% to 13% over spot in calm markets, are currently trading at premiums of $7 to $10 per ounce when spot is around $75. Representing roughly 9% to 13% premiums, consistent with normal ranges but not compressing despite falling futures prices. American Silver Eagles and Canadian Maple Leafs are trading at premiums of $10 to $17 over spot, reflecting continued retail demand. In select international markets, the divergence has been more extreme. Reports from early January 2026 indicated that physical silver in certain markets, such as Japan and the UAE, was commanding premiums as high as 80% over COMEX futures prices, with coins selling for $130 per ounce when COMEX was trading near $72. Major bullion dealers have experienced inventory constraints. During periods of heightened volatility, several dealers have paused or limited buyback programs, meaning they're not actively purchasing physical silver from customers at normal spreads. This is significant. In a weak market, dealers compete for inventory because they expect to resell it at a profit. When dealers pull back from buying, it signals they're uncertain about restocking at current prices, or they're protecting existing inventory during volatile pricing. The physical silver supply chain is experiencing stress at multiple points. Refiners are reportedly managing backlogs as demand for both institutional bars and retail products remains elevated. Distribution timelines have lengthened in some cases. Shanghai silver inventories have fallen to their lowest levels since 2016, according to market data. COMEX registered inventories, the metal available for delivery against futures contracts, have declined approximately 70% from their 2020 peak, dropping from 346 million ounces to around 82 million ounces. Here's the key insight. Weak markets flood supply. When holders of physical assets panic, they sell into the market, driving prices lower and increasing availability. That's not what's happening here. Instead, we're seeing the opposite. Physical scarcity is tightening liquidity. Dealers are restricting sales, premiums are staying elevated or rising. Inventories are being drawn down. This is the signature of a market under supply stress, not price collapse. The physical silver market isn't breaking, it's tightening. So why are these two markets behaving so differently? The answer lies in what they represent. Paper silver represents claims and promises. A futures contract is a promise to deliver silver at a specified price and date. An ETF share represents a fractional claim on silver held in a vault. A derivative is a financial instrument whose value is derived from silver, but may never involve physical metal changing hands. The vast majority of paper silver trading is settled in cash, not metal. The physical silver market, by contrast, represents possession and delivery. When you hold a silver coin, you're not holding a claim. You're holding the actual metal. There's no counterparty risk, no settlement risk, no question of whether the metal exists. It either exists in your hand or it doesn't. The problem emerges when the volume of paper claims vastly exceeds the amount of metal available for delivery. According to recent estimates, the ratio of paper-silver contracts to physical silver held in registered vaults has at times reached as high as 356 to 1. This means there are 356 ounces of paper silver traded for every 1 ounce of physical silver available to back those contracts. In normal times, this doesn't matter. Most contracts settle in cash. Most investors never take delivery. The system functions as long as trust holds. But when trust begins to erode, when participants start questioning whether they can actually get metal if they demand it, price signals become distorted. When claims vastly exceed deliverable supply, markets shift from being price-driven to being availability-driven. Traders and investors start caring less about the futures price and more about whether they can actually get their hands on metal. This is when premiums blow out. This is when lease rates spike. The cost of borrowing silver has surged to around 8% annualized, compared to typical levels of 0.3% to 0.5%. Signaling acute tightness in physical borrowing markets. This is when physical buyers become willing to pay far above the quoted spot price just to secure supply. Such divergences are not unprecedented. They tend to appear during late cycle phases or periods of systemic stress. In 1980, during the Hunt brothers' silver corner, physical premiums spiked even as futures markets collapsed under regulatory intervention. In 2011, after silver surged to nearly $50 per ounce, margin hikes crushed futures prices while physical demand remained robust for months. The pattern is familiar. Leverage breaks first. Physical supply adjusts more slowly, creating a window where the two markets decouple. Let's bring this back to the practical level. What does this divergence mean for someone trying to navigate the silver market? Paper silver, whether futures, options, or ETFs, is designed for liquidity and speed. It's a trading instrument. You can enter and exit positions quickly. You can use leverage to amplify returns. But you're also exposed to margin risk, counterparty risk, and the volatility that comes from leverage unwinding. Paper silver is sensitive to positioning, sentiment, and the mechanics of derivatives markets. It tracks the price of silver, but it is not silver. Recent data shows that silver ETFs like SLV experienced net inflows of over $920 million in the past 30 days as of late January 2026, indicating strong investor interest. However, these same instruments are subject to the volatility we've just described. When futures markets break, ETF prices move with them, even if the physical metal backing those ETFs remains secure. Physical silver is slower, less liquid, and comes with storage costs and security concerns. But it is not subject to margin calls. It cannot be liquidated by an exchange. It has no counterparty risk. You own the actual metal. Physical silver is sensitive to supply chains, refining capacity, and real demand from industry and retail buyers. It is wealth insurance, not a trading vehicle. The choice between paper and physical isn't about which is better, it's about alignment. Are you trying to trade price movements, or are you trying to hold wealth outside the financial system? Are you comfortable with leverage and volatility, or do you want an asset that can't be seized, rehypothecated, or settled in cash against your will? The key is to think in terms of purpose, not prediction. Don't ask, will silver go to $150? Ask, what am I trying to accomplish, and which instrument aligns with that purpose? If you're trading, paper silver offers the liquidity you need. If you're building long-term insurance against currency debasement or systemic risk, physical silver offers the certainty you need. Trying to use the wrong tool for the job is where most people go wrong. Align your instrument with your intent. That's the framework. None of this is happening in a vacuum. The silver market, both paper and physical, is responding to a broader macroeconomic environment that's creating structural tailwinds for the metal. Silver is no longer just a monetary metal. It's a critical industrial input. The energy transition, electrification, and technological advancement are driving record levels of industrial silver consumption. Solar panels require approximately 20 grams of silver per panel. Electric vehicle batteries use roughly 100 grams per vehicle. 5G infrastructure, semiconductors, and AI data centers all rely on silver's unique conductive properties. According to industry data, industrial demand has pushed silver into structural supply deficits for 5 consecutive years, with cumulative shortfalls estimated at over 800 million ounces, nearly equivalent to 1 full year of global mine production. On the supply side, silver production is largely inelastic. Approximately 75% to 80% of silver comes as a byproduct of copper, zinc, and lead mining. This means higher silver prices alone can't stimulate significant production increases. Base metal economics have to justify the mining operations. Primary silver mines account for only about 25% of global output, limiting the supply response even when prices surge. Adding to the supply stress, China implemented new silver export controls on January 1, 2026. The country controls approximately 60% to 70% of global refined silver supply. Under the new licensing framework, only large, state-approved firms are permitted to export silver. This regulatory shift effectively elevates silver to a strategic resource within China's industrial policy, prioritizing domestic supply for solar, electronics, and other critical sectors. The move is already fragmenting global silver markets, with Shanghai spot prices at times trading at premiums of nearly 10% over COMEX futures, a divergence rarely seen and a clear signal of acute regional supply stress. Beneath all of this sits the macroeconomic reality of currency debasement and escalating debt servicing pressures. Central banks continue to manage unprecedented debt levels while navigating inflation and growth concerns. The US dollar recently hit multi-year lows, and trust in fiat currency systems is being quietly questioned by both institutional and retail investors. Silver, like gold, benefits from this environment, not because it generates yield, but because it exists outside the debt-based financial system. This brings us to a deeper point. Silver's role in this environment isn't just about supply and demand, it's about settlement and trust. When claims exceed physical metal, when leverage becomes unsustainable, when markets fragment along regional lines, what matters is not what the price says, but whether you can actually settle in metal. That's the macro backdrop. That's the context in which this paper-physical divergence is unfolding. Let's bring this together. This is not a silver price story. It's a market structure and delivery story. What you're seeing is 2 different markets responding to the same underlying stress in fundamentally different ways. Paper silver is breaking under the weight of leverage and margin pressure. Physical silver is tightening under supply constraints and elevated demand. The divergence exists because paper silver represents claims and leverage, while physical silver represents possession and delivery. When those 2 realities pull apart, price signals become distorted, and understanding the structure becomes more important than watching the price. The key takeaway is this: paper and physical silver respond to different stresses. They serve different purposes. They carry different risks. Aligning your exposure with your intent is the only way to navigate this coherently. In upcoming content, we'll explore several related topics: why dealers stop buying physical silver during volatility, and what that tells you about real supply conditions. The structural risks of ETFs versus physical ownership, including counterparty exposure and settlement mechanics, and how liquidity crises actually unfold in precious metals markets, using historical case studies to understand the patterns. I'm building this content based on where this audience is positioned and what risks you're managing. If you're holding physical silver, your concerns are different than someone holding SLV shares or trading futures. Let me know in the comments where you stand: physical holder, paper holder, or still deciding, and what questions you need answered. That feedback will shape the next analysis. This is a market under structural stress. Understanding that structure is how you navigate it.